the recovery from a bear market either comes two ways, either kind of it comes up, corrects, and then eventually goes, or it comes sharper. It depends on central bank action, liquidity, that kind of stuff. But if I look forward, I'm very bullish because we've just gone through the rate cycle. It's the rate of change that matters. The rate of change comes down first, then sticks. So that's good for risk assets. We've marked down everything in value and price. And then we've got, I've been talking about this a lot, the exponential age technologies. We were talking about Tesla, but anybody's been paying attention has seen what happened to AI. It went from me interviewing Emad to say, oh my God, this is coming, to ChatGPT, to everyone thinking, oh shit, we're out of a job within 3 weeks. I mean, that ChatGPT went from 0 to 1 million users in 4 days. We've never seen anything like it. And it keeps crashing. There's so many users on it. So that's the technology. And we've got tons of these coming. The energy situation that you've been following so closely, the nightmare in Europe didn't pass in the end. It's, we saw what was bad, but the Peter Zeihan's of the world and others were like, the Europeans are going to be having to be chipping frozen corpses from the streets. That doesn't look like that's happened. Nobody's run out of energy. Yes, there's been some rationing and stuff like that, but it seems to be contained. So also investors were so negative that I've got charts going back to the 1970s, the AAII investor intelligence survey. It was the most negative since 1970 or something crazy. So usually when all of those things happen and we've got liquidity returning, markets are pretty positive. So I love this series because I think everybody's looking that way, and that usually means the opportunities to look the other. But I'm hearing more of this kind of mild recession, soft landing calls from people, and I don't know really yet. I don't really see that. I see short and sharp, and we'll talk about that later in the second half. But I don't really see the mild element. Maybe it's to do with, if we go back to 1980, the Volcker one, right? Everyone talks about that as like this terrifying recession. It was actually a really mild one. And the S&P went down 28%. And that was it. It was kind of over and done with. So maybe there's something to do with nominal versus real. That means that prices remain, demand remains higher because of nominal. Is that the inflation weight is less, and therefore the rate of change of interest rate increases. The Fed are making it pretty clear they're probably going to go to 25. So it's, as you know, in global macro, it's the rate of change that matters more than anything else, not the absolutes. So if the rate of change changes, all these beach balls start popping out of the water that have been held down by the heavy weight of interest rate rises and that rate of change. That's all gone. So suddenly, emerging markets go up, gold goes up, crypto goes up, equities go up. That whole story. I don't know what the BOJ is doing. I've kind of lost track of them. I almost kind of, I know it's a bad thing to say, ignore it, because people over focus on Japan. And in the end, it's still pretty contained. It's not like they're going to let rates go to 2%. So, and are they going to, I was having this conversation with Julian Brigden earlier on the Insider Talks, is are they going to let it all go and just give up yield curve control and walk away? I mean, no, they've just widened the band. Why would they suddenly decide, oh, you know what, we're just going to let interest rates run wild in Japan now and completely destroy everything? So, but interesting market overall. I mean, it's been a very risk-on week, very risk-on. Think of that beach ball, right? There was another weight on the world, which was the world's largest trading economy, was closed. So if you reopen, then the beach ball rises. So anything that has Chinese exposure is going to see a net marginal increase in demand from where they were. So I think it's just that. The question is does China coming back into the world economy mean anything yet to the global economy? My tendency is to think that China, again, we'll talk about this later, the Chinese credit cycle, the Chinese money supply tends to lead currently the Western world by about 12 months. So I think if we're thinking of what's happening now, then we've got a 12-month lead time before it starts filtering into the rest of the world as well in some respects. So And the rest of the world, the impact on the rest of the world, people are like, well, China's opening commodities. It takes time because the Western demand is still going down. So it's really going to make a difference to the commodity market that so many people are looking at is when all three engines are firing: Europe, China, US. When those three fire, then you've got a potential long-lasting commodity rally. But without it, you've still got one or two of the legs of the stool missing. But it proves the point, and it's the point that even Elon Musk was making, is the inflation picture turned a while ago. I mean, I remember him in the summer saying most of the basket of stuff we're buying is down 50% from the high. And it was like, no, it's not, But so I think what we're seeing from this is, if you think of what two businesses of Elon Musk, one is Twitter, one is Tesla. What has he done at Twitter? Laid off tons of staff. And what has he done at Tesla? Cut prices. That's a recession for you, right? That's exactly what recessions are all about. That's exactly what the Fed want to see.